Aashish Sommaiyaa, WhiteOak Capital with us. Ashish, great having you as always. Thanks so much for taking the time out. And you know, this is a milestone and people might say, okay, iske baat kya? But this is an important one, right? Amidst all of this talk of consolidation which has happened, we might hit all-time highs amidst a confluence of positive events, including earnings, including a lot of policy action and a potential trade deal as well. How are you feeling about this?
Yes, I think, Neeraj, I think all mutual fund investors and most participants at large, typically, the exciting part about all-time high is that, barring people who are holding direct equity, I mean, people who are holding portfolios of any sort, especially mutual funds, when there is a new high, the good thing is that pretty much nobody has money above, money below the water. So I think that gives a kind of, renewed confidence to people who are investing, and it's good to break out of the rut of maybe the last 12 to 15 months. So yes, I'm sure you will see, increased participation actually because of, if we get more clarity on some of the things that you just mentioned.
Ashish, morning, Alex here. So speaking of those mutual fund investors, right, a lot of them will not necessarily have seen the kind of run that you've seen at the large cap end because there is a tendency to go broader and mid cap and small cap allocation. The question is that in this sentiment up move, do you see significant flows coming back at that end? Because really, those SIPs are primarily geared towards the broader markets.
Yes, I think, in fact, in the last few days, you have seen some consternation about the fact that, while the index is making new highs, a lot of people are not necessarily seeing new highs in their portfolios. And I think because last year when Nifty was 26,000, what was driving the markets was maybe more small cap and maybe more cyclicals and macro-driven or PSU-driven components of the market. And this time around when it is 26,000, it's a different set of components which is driving the market. And you're right that there is a huge tendency to chase one-year return. I mean, as recently as September 2025, the category which got highest inflow was actually gold and not really, the typical diversified funds. So there is a tendency to chase last 1 year return, and maybe that would draw attention towards large caps, as you rightly said. I think that would be ill-advised. If there is any learning from recent times, the learning is to keep the portfolio broad and diversified. And I don't think that any such trend goes beyond a year, year and a half at best. Ultimately, it's a diversified portfolio, which is, carefully constructed to beat the benchmark. I think that is what really plays out well.
There are two notes today. There's Macquarie and JP Morgan, both who have looked at 30,000 as the base case for the Nifty by the end of 2026. I know we're obsessing about this all-time high because it's, it's fun for the day. But do you think that that's a realistic outlook, 30,000 by 2026 on the Nifty?
So see, I would actually divide, since it talks end of 2026, I would actually divide it into two parts. Personally, if you ask me, this recent up move, I know results have been, at least there is some change of trend as far as results are concerned, and there is positive talk on, US-India FTA. In fact, there is a sector rotation also because people are a bit more confident about stuff like IT and all of those. So a lot of swords which were hanging are probably getting cleared, but I would still divide the next 1 year into maybe two parts, the immediate 3 to 4 months or 6 months, and then the latter part. I feel that there is still this sword hanging on the market which is related to the US markets, the US economy, US economic conduct itself. And on the other hand, what we saw of yields rising in Japan and what kind of fallout it can have. And of course, geopolitical issues are not like they've been on a back burner, but I don't think one should just generally assume that it's all settled. So given all of these things, I would still say that next 3 to 6 months, if there is any of this precipitates, we will get dragged down with the rest of the world. So I would be careful of extrapolating what is happening right now. I would be careful of extrapolating it in the next 3 to 6 months. But once some of these items precipitate, then maybe the market can move on. So I think that latter part of 2026, or whatever imaginary 1 year that I'm dividing into two parts, the latter half of that would probably be more amenable to what you are or what those reports are projecting. But the near term, I would say one still needs to be careful and not get carried away with, the recent momentum.
A note of caution that we should not get carried away and think that 30,000 in 2026 is a given. Aashish Sommaiyaa, CEO of WhiteOak Capital AMC there. Thank you so much, Aashish, for joining in.